Hello everyone, I am Riddhi Miglani and we are discussing the Economic Survey 2021. So we are talking about the Indian economy on the path of a resilient V-shaped trajectory. So at the start of the lockdown, there were a lot of discussions which letters shaped the economy we will see. So there were letters like L, K, W, V, and so on and so forth. And India has actually seen a V-shaped rebound. Now, when we talk about core index and IIP stands for Index of Industrial Production. We see that at the time of the lockdown, when there was restriction on movement, were actually terribly down, and then since then we have recovered. And for India's growth to continue, it is necessary that the growth in core index and IIP continue. And this is about e-way bills. Now, e-way bills are a strong leading indicator of revenue collection, supply chain corrections, and logistics growth. So this one clearly tells us that yes, there were supply side shocks due to the restriction on movements. These two have come back because now it means to say that there are no more restrictions. And this is a representation of inflation. Now this light box colored box, we clearly see now these are the levels of inflation with which RBI is totally okay. Now RBI wants to maintain India's inflation at 4% within a plus minus 2% deviation. So that's like 2 to 6% inflation, and RBI is totally okay with it. And when we talk about this blue bar, that is the combined CPI, after the lockdowns were lifted, it was clearly above the levels with which the RBI is okay. So that means what? That RBI's next target is inflation. And when we talk about wholesale bank credit, now wholesale bank credit is nothing but a large amount that is lent by the banks. So this is usually in the case of corporate sector. Now we see that there has not been any kind of recovery here. It could be on two accounts. One is that the banks are risk averse, they don't want to lend at the moment, and or they want to lend to the highly credible people or the companies. And second could be that the private sector itself is not taking much part in capex right now. And when we talk about GST collection, now why is it important? Because GST collection is nothing but a proxy for the revenues that are earned by the private sector. So during the initial phase of the current financial year, we see that this blue line is FY20 collections, and the green bars are the current financial year's collections. So we clearly see that Y on Y basis we were negative, and since September we have turned positive, and since October our collections have been at least 1 lakh crore rupees. And when we talk about, because this year the governments have borrowed massively, so the yellow bar is of financial year 20, and the green is that of the current financial years. And we see that the government has been aggressive on borrowing, be it the center or be it the state. And one good thing about the borrowing is that the GSEC yields have come down. So GSEC yield is nothing but the rates at which the governments borrow. So initially it was a downward sloping, and then towards the end it has become more or less flat towards 6%. And then we talk about our current account balances. So we see that right now we are at close to 2.5% of GDP. Like this is a current account surplus, and it's good because that means what, we are getting more and more of forex with us. And if we see here that our services sector across all data points has been supporting our current account, which is also mentioned here, that India recorded a current account surplus of 3.1% of GDP in the first half of the year, largely supported by strong services exports. And also in first half of the year, the current financial year, we see that our exports had fallen by 21.1%, and our imports fell more severely by 39, close to 39%. And going forward, while prospects of external demand normalization are underway, its pace is contingent on the global COVID-19 outlook and successful rollout of vaccinations across the world. Because if we talk about Europe, much of the Europe is actually in lockdown. So of course we see that there will be an impact on demand and supply there. And when we talk about equity inflows, my God, I think it was a beautiful year when we talk about equity inflows for India. And when we, in fact, we see it for ourselves when we compare it with so many nations here. And we have seen the journey ourselves from March 7500 levels to 15,000 levels. It was quite a journey. And okay, when we talk about that, there have been many like there have been a good level of FII inflows. It means that there must have been demand for rupee, which means that rupee must have appreciated to a very good level. But this has not been the case because RBI's prudent interventions in the foreign exchange market limited the appreciation. Now this has happened because the government, it wants to keep a good export this time and less imports. Because what happens is, if our rupee appreciates, our exports, they will not be that competitive, but our imports will, they will of course go down, like in the sense like they will not be that expensive, and hence our imports will increase. But the government doesn't want us to be dependent on imports, especially when it is talking so much of Atmanirbharta. And when we talk about external debt, so external debt, it is mostly denominated by the private sector, and this is that blue line which we see that it's largely unchanged. But we see that the debt service ratio for India has gone up. Now this is on account of our increasing forex reserves. In fact, I think in January end it was close to 590 billion US dollars. And hence we see that India is actually on a V-shaped recovery to pre-pandemic levels and beyond. And of course, we have to sustain it no matter what if we want to continue our growth. So this is it about this video. We'll continue more in the next one. Thank you.